Alright, greetings, sports fans. Oh, wrong lecture. Sorry. Greetings, state, local tax fans. We're going to have a quick summary of the basic concept of state taxes. Certainly, in the short time that we'll spend on this, it can't compensate for everything we did in class, but we'll go through as many big points as we can to highlight the big picture. So hopefully this will help you get a good takeaway from the whole course. So the world of state taxes, we covered a lot of this ground, but we didn't spend a lot of time on certain aspects of it. It just gets too complicated, and there's just too much. But you can see from the different types of taxes that states impose on businesses and individuals, there's a lot of taxes. When you add up the taxes you pay to the federal government plus what you pay to the state in the various taxes that exist, it can turn out to be a lot of money. Now, of course, not every state has every one of these types of taxes, and some of them have more taxes than we have here. For example, one block missing is an estate tax. Many states, Maryland included, have estate and gift taxes as well. And there may be excise taxes. So that could be another one. Other types of excise taxes. Do they have that here? You could have a tax on tobacco, gasoline. Wow, lots of taxes can exist. First, let's talk about business tax. And here, the concept, this is one of the highlights of the course, was the definition of nexus and how to determine it. And if you got confusion out of it, then you were really paying attention, because it is confusing. At one time, maybe about 5-10 years ago, the concept of nexus, if you had asked the CPA what it means, they could have given you a pretty precise definition. But in the new economy, with internet sales and with states hungry for money, the concept of nexus has gotten blurred. But what it is the minimum contact required before a state is able to be subject to out-of-state company state taxes. In other words, where you're incorporated, you're definitely going to pay tax where you're incorporated. But if you're doing business in other states, how does that work? Depends on how you're doing the business in other states. You have to have contact. You have to have this nexus. If you have the nexus, then you have to register as a foreign entity, because you're not incorporated that, but you have to register that you're doing business there. If you have nexus, you have to file and pay payroll taxes and business income taxes and perhaps franchise taxes and maybe gross receipts taxes. We're not talking about sales tax issues yet. That's going to be a next part of this. Right now, this is just the income tax. And then, of course, what the course was designed to do is to impress upon you this one factor. Isn't it wonderful? Here's the types of things that can create nexus. If you have employees in the state or traveling to other states, certainly if you have an office. I think all states today would say if you have an office, then you have nexus. All states today would pretty much say if you have inventory there, you've got nexus. Warehouse, same thing. This could vary from state to state. Depends on the circumstances. And if you're a partner in a partnership doing business in another state, that could cause you to have nexus there as well. Depends on the situation. We didn't cover this because it's much more complicated, but you should know about it. Here's what we call protective activities. You can do these activities and, generally speaking, won't cause nexus. Let's see if we agree. And this one should sound familiar since we're talking about income taxes, because the first one deals with employees sending the orders out of state for approval and processing, where you have sales of tangible personal property. And this should sound familiar because it is Public Law 86-272, a federal law that goes back to 1959, designed to solidify the various interpretations between states when it comes to nexus, only with regard to sales of tangible personal property. All right, so this slide is just pointing out that it's important for a corporation to know whether they have nexus in different states, something that they're going to have to research. So major corporations or businesses doing interstate commerce, we're going to have to look at, and they're going to have to determine if they're computing their tax amongst the various states correctly. It causes an extra cost to be involved in other states. This was because I was involved in a seminar on international tax when it comes to state taxes, so we'll skip over that. This was just designed to show the people. This seminar was given to companies in Israel doing business in the United States. It was to give them an idea that the fact that the states are, in the United States, are experiencing fairly huge deficits in their budget, which states they are, and to understand that that's why states are hungry to tax their income earned in the United States. All right, for business tax purposes, this is the formula. We've spoken about it in class and on the videos on the net operating loss. It often works with where it starts with federal taxable income, has plus or minus adjustments to get to the place where we'll apply the apportionment factor, get the tax base, apply the rate, liability. There are numerous differences between the states that can create different results other than what we would have hoped for with the apportionment, and particularly with more aggressive nexus approaches, such that more businesses will wind up being taxed in other states, where some states they won't be taxed in other states doing the same thing. It depends on how aggressive the state's law towards creating nexus will be. And here are some of the more aggressive nexus approaches. So this is the issues that I wanted to cover in this review. Economic nexus, and it is where states no longer require physical presence to establish that nexus. It affects companies that are generating income from licenses, royalties, trademarks, as well as others. And to add to what you see here, the concept is that what the states are doing is they are actually looking at Public Law 86-272, and to a certain extent, they're ignoring it, waiting for someone to really challenge them in court and let it go to the Supreme Court to be interpreted. Because Public Law 86-72 only involved tangible property and only involved the solicitation of sales. So you could have a situation where the economic nexus is that click-through nexus that Amazon is involved in, which we spoke about in class. And it can certainly and most probably be involved in something to do with the internet, where sales are occurring through the internet in another state. And that other state will say that you've got economic nexus, which translates into the state saying you have sales in our state. Since you have sales in our state, that's an economic connection to our state, and they're going to subject the income based on what you're doing in that state, the sales that is, to tax in that state through a nexus approach. We spoke about California as an example. If the sales in California exceed this number, or if the sales in California exceed 25% of the company's total sales, then they'll be considered to be economic nexus to California, and business tax will apply. Other states that have ventured into the same game are these states, and since this was 2012, when I was involved with this seminar, it's increased. More states are applying the economic nexus concept. Public Law 86272, that is, does not apply to sales of services. So it's been easy for the states to expand nexus on service business. And it has this particular type of expansion, the economic nexus, has not yet been challenged fully in court. And one of the reasons is that the federal government continues to put out each year the concept of passing a law which will change Public Law 86272 and have a different way to deal with nexus amongst the states to help bring back order in interstate commerce. Just as a conclusion for this part of the review, at the webinar or the seminar we gave, we talked about the fact that the states are increasing their audits in order to gain revenue. And so that was a warning to companies doing business in the United States from outside, in this case particularly Israel, to be on the lookout to comply properly with the various states' rules. And we'll pick up at sales tax in the next video.